A capital market serves one core economic function. It acts as a transfer engine. It moves funds from surplus units, individuals or institutions with excess capital, to entities that require long-term financing, with maturities stretching beyond a single year. This financing operates on two parallel, distinct tracks. Entities raise funds through equity, selling direct corporate ownership, or through bonds, which represent contractual debt. To an outside observer, the outputs of these secondary markets appear dense and arbitrary. The continuous flow of flashing tickers, fluctuating prices, and percentage yields can easily look like noise. We can bypass that noise by isolating two specific market signals, an equity index shift and a fixed income bond quote. By reverse engineering the math behind these numbers, we expose the exact mechanics of how capital is priced. Capital markets are highly structured mathematical environments. Every quoted price, whether a share of stock or a sovereign bond, reflects a precise calculation, weighing future risk against the passage of time. Common stock is the baseline residual ownership claim in a corporation. When investors hold common stock, they gain voting rights and limited liability, meaning their losses are capped at their initial investment. In exchange for this ownership stake, they accept that dividend payments are entirely discretionary. Corporations initially raise capital in the primary market, typically issuing new shares to early investors through investment banks. Once those initial shares are distributed, they begin trading between public investors in the secondary market, such as Bursa Malaysia. Measuring the aggregate performance of thousands of individual trades requires a composite tool. This is the function of a stock market index, such as the FTSE Bursa Malaysia KLCI, which tracks a specific basket of listed companies. We determine movement by calculating the percentage change in the index quote. If the KLCI opens at 1,500 points and closes at 1,550, we subtract the old value from the new, divide by the old, and multiply by 100. The index shifted positive 3.33%. That 3.33% increase indicates a collective rise in the total market value of the largest listed companies in Malaysia. Because equity has no guaranteed returns, this upward shift is driven purely by rising investor confidence and updated expectations of future corporate earnings. Fixed income markets strip away the variable nature of equity. Bonds are rigid, long-term debt obligations. Governments and corporations issue them to secure immediate funds for major capital expenditures, promising legally binding repayments to the bondholders. We read this contract from a raw quote. MGS identifies the issuer as Malaysian government securities. The coupon rate guarantees 2.632% interest annually on the face value. Finally, the maturity date. On April 15, 2031, the issuer must redeem the bond and return the principal. A stock index moves based on the fluid anticipation of growth. A bond quote lays out a predetermined contractual schedule of cash flows that the issuer is obligated to meet. Because government bonds are backed by national taxation, they carry extremely low default risk. Corporate bonds, however, are tied strictly to a company's future operating earnings. If those earnings falter, the corporation risks defaulting on its coupon payments. To accurately price this uncertainty, the market relies on independent credit rating agencies, institutions like Moody's, Standard & Poor's, or Malaysia's RAM Ratings and Mark. Their sole function is to evaluate a corporate issuer's financial health and quantify their probability of default. Agencies assign specific grades to debt issuances. The top tiers, down to Baa3, represent investment-grade debt, indicating minimal to moderate credit risk. Falling below that threshold places a bond in the speculative grade category, signaling a high probability the issuer may default. This creates a direct mathematical consequence for the issuer. To convince investors to purchase highly rated safe bonds, a low coupon rate is sufficient. To attract capital to a speculative, lower-rated bond, the issuer is forced to offer a significantly higher coupon yield to offset the risk. Once a bond is issued and enters the secondary market, its price begins to fluctuate. If the coupon rate is permanently locked in, how do investors determine the fair trading price on any given day as global interest rates shift? The valuation relies entirely on the time value of money concept. The intrinsic market price of a bond is the present value of all its expected future cash flows, heavily discounted by current market conditions. This formula calculates present value, or PV. The numerator, CF, contains the promised cash flows, annual coupons plus the final par value. We divide those dollars by the discount rate, R, which is the specific yield the market requires for that risk. The outcome of this equation dictates the bond's status. If the coupon is lower than the market yield, it trades at a discount. If the coupon exceeds the required yield, it trades at a premium. If they match, it trades at par. Bond pricing leaves no room for speculative guesswork. It is a rigid mathematical discounting process where dollars promised years from now are systematically repriced based on today's interest rate environment. These two capital tracks serve distinct investment needs. Equity provides capital appreciation and a slice of perpetual ownership based on variable growth. Bonds provide highly structured, rated liquidity with fixed maturity dates. Applying the present value formula reveals the fixed income market's core reality, the inverse relationship between interest rates and bond prices. When market rates rise, the present value of older, lower coupon bonds mathematically falls. Conversely, when interest rates drop, existing bond prices rise. A stock index and a bond quote are not arbitrary numbers. By breaking them down, we uncover the vast structural machinery the financial system uses to assess credit risk, project the value of time, and assign a fair price to capital. Whether an investor takes an ownership stake in a corporation or extends a loan to a sovereign government, the capital market translates their excess funds into a precise mathematical spectrum of risk and reward.